Neelkanth Mishra from Credit Suisse on the show with us. Neelkanth, hi, good morning. Good to have you on the show. You know, I was just reminiscing that same time last year, you had the Prime Minister announce the lockdown effective midnight. And from there, Neelkanth, I mean, we saw a 13% cut on both the Sensex as well as the Nifty on 23rd March. You had the Nifty Bank collapsing about 17%, and consecutively you had double digits cuts on the indexes for almost a week or so. From there, Neelkanth, while it's been largely a one-way move up, about almost 70-odd%. I was just chatting with Nilesh Shah from Kotak AMC as well, and, you know, reminiscing on the year gone by, he said, I wish I had that wisdom to sell Jan end and buy the market crash March end. But since none of us can really time it to the T, as you look back, in reflective, retrospective mode, what do you think you did right and could have done right?
Yeah, thank you, Aisha. Pleasure being here. Thank you for having me. So there, of course, in hindsight, it looks very clear and very attractive. I did try to think through the 5-year growth. We modeled a lot of, we did a lot of theoretical modeling as to what does a lockdown really mean, in the sense that how is it different from, say, everyone going on vacation together? And the outcomes from that, we did realize that the lasting damage to growth would actually be a lot lower than what previous crises had shown. But even then, what we, I think, underestimated was the law of the jungle, or the power of the law of the jungle, which is that if there is a drought, then the big animals get to drink as much as they want or as much as they can, and the smaller animals get squeezed out. So one of the most important takeaways from me was that during the lockdown, the larger firms, the richer households did far better than the smaller firms and the poorer households. This, in many ways, while it is, I think, terrible from a wealth and income inequality perspective, is actually quite positive for the growth of the economy. And in hindsight, maybe I should have thought about that as well, even while I was doing that theoretical modeling. So while the market has bounced, and I think the reset in the economy, which I've, I think, talked about on your show as well earlier, that the growth of FY22, that is the level of GDP in FY22 over FY20, I think those numbers need to be increased meaningfully. And that's notwithstanding the current surge in cases that we are seeing. But more importantly, I think the medium-term outlook of the economy has, I think, improved over the last 1.5, 2 years. And that's where I think the market will start focusing once it's through this volatility of, you know, what's happening to the case count, what's happening to the death count, what's happening to the pace of vaccinations. As we start thinking about the next 3 to 5 years, I think the prospects of the economy look a lot better than they did when we were thinking about it in 2019.
Absolutely. You know, while the rich definitely got richer and poor got poorer, but that was only in the initial phases of the lockdown. What one saw, Neelkanth, after that was an unprecedented pace of new companies getting formed, a lot of innovation, especially when it came to tech and digitization. You yourself have recently done a study on 100 unicorns and how the corporate landscape is changing. Help us understand, going forward, 5 to 10 years, what is it that we are looking at when it comes to the entire texture and shape of India Inc.?
Thank you for that question. I think I'm very excited by it. In fact, this whole report was triggered by a view shared in a group meeting I was in January, that we have about 25, 30 unicorns. And I think by the end of the year, we could be at 35, 40. And that set me thinking that if the pace of $1 billion plus companies is the formation of $1 billion plus companies is that fast, then what are the implications for the economy? And so we went about, we called up all my friends in private equity. We also did a screen. So, we shouldn't be biased against firms which are kind of self-sustaining, self-funding, like, the fascinating new trend of software as a service, where the shift to cloud computing has changed the way software is developed and used and paid for. And that's creating massive opportunities in India in terms of jobs, in terms of incomes, and of course, in terms of wealth creation. Now, when I started exploring these, we figured that more than 100 companies. Towards the end, there was one cynical question by an investor that the 100 looks like a very round number. I mean, have you bumped it up or have you brought it down? And I think we had to cut down numbers. In fact, after we published the report, we got to know of many new companies, many additional companies that we could have added. So it's not just in the tech space, right? So the conventional e-commerce, the edutech, the fintech companies, which of course have many other drivers which have been accelerated, as you rightly said, during the pandemic. But it's also companies in software, in biotech, in pharmaceuticals, in consumer goods, even industrials. And I think the fascinating thing is it's a very diversified set. In many ways, it is also self-perpetuating. So the reason why I think there is so much activity, compared to 330 odd companies in the listed space, which have a $1 billion plus valuation, if there are more than 100 companies in the unlisted space, which are valued at more than $1 billion, and 2/3 of them have been started after 2005. So what changed? What has driven this? India, the entrepreneurship in India has always been there, right? So even in the 1980s, the pace of private firm registration, if you look at the companies, Ministry of Corporate Affairs data, the growth was still in double digits. The problem was there wasn't enough capital, right? Because India's wealth per capita, and continuing with what your previous speaker was saying, India has very low wealth per capita. And a very small percentage of that is in financial assets. So the new investments and the size of new investments was being curtailed by that. The surge in private equity has been absolutely transformative. So what we found was that in each of the years of the last decade, private equity injections have been bigger than public market equity fundraising. And now that it has created these 100 plus unicorns and $240 billion plus, maybe $300 billion of valuation, there is $35 to $50 billion of new wealth created for the promoters of these firms. Now, a lot of this is going to get reinvested in risk capital, and the kind of firms that are getting financing now in the last 5 years is absolutely fascinating. They're targeting Indian problems. They are using the highest end of technology. They are supremely talented. They have experience. I was listening to a session on edutech yesterday, and it is really impossible to say which firm, whether founded in the US or founded in India, is going to dominate that space, because it's all about content and it's about the internet. And what the pandemic has done is it has brought down the inertia of using educational content or training content on the net. And once you're on the net, it's independent of whether the content was created by a US firm or an Indian firm. Indian firms are now generating revenues in the US. In software as a service, earlier, I remember friends of mine who've set up very successful companies. They set up their India development centers 3 to 5 years after, and they were in Bay Area, and they set up their firms here. In their second startups, some of them, of course, I've been doing several of them. In the first 6 to 12 months, they started setting up the India Development Center. So it's not surprising that the talent development, the shift from services to products, and SaaS is actually, somewhere in the middle, and therefore easier transition, is actually happening at a very rapid clip, because all of that talent is now feeling that they can do it themselves. The number of software as a service startups is mushrooming. Of course, there will be excesses and there will be a shakeout. But the number of unicorns you see in software as a service could actually accelerate. So there are some very fascinating trends happening. I mean, why can't? And then there was another comment which I found fascinating, that, in 1995, who would have thought that most of the software in the world would be made in India, or that 45-50% of the workforce of large global banks will be based in India. So in the next 15 years, in the next 5 years, why shouldn't educational content, training content, quizzing content be actually all developed in India. And so there are significant medium-term changes which have been triggered and accelerated by the pandemic, which are, I think, very positive for a country like India.
The views that you were just highlighting earlier, the one thing that is clear is that IT is going to continue to be an enabler. The question is, will the current listed IT universe be the enablers for these budding unicorns that you highlighted, or for that matter, any and every business platform which is now having to transform into the digital mode? And for that matter, the point that you made about funding, will it be the listed NBFC and banking universe, or would it continue to be private equity firms?
Right. So, great set of questions. So let's start with the enablement of IT. I think IT, let's keep the listed sector aside for a time being. I think the fact that this sector scaled up, that we have 45 lakh, 4.5 million IT engineers in India, is, I think, a very massive enabler for a lot of other changes, right? So it's much cheaper to develop software. Anyone can set up a website. When thinking about a startup, the challenge is not where to get the developers, right? The challenge is to come up with the idea and all that. So the fact that there is this massive pool of resources trained, and now with reasonable maturity. I mean, when we started off, most of the work was, 25 years back was Y2K and mainframe and backend coding. And now, because of some of the things I explained, some of these developers are right at the edge of it. Right? When I was a technical architect 20 years back, just trying to participate into sort of standard formation, etc., was a challenge. Now I think a lot of Indian firms and Indian engineers will be there. So this has enabled it. But for the IT services firms themselves, this actually is a challenge and an opportunity, in the sense that if the best quality engineers, I mean, if you look at the basic business model, right, the IT business model is you pay someone ₹1 million and you try to get maybe ₹2.5 million of revenue by providing services to some customer, and then you make maybe $500,000, right, 20% kind of margin. In the SaaS model, in the development models that are emerging now, you can potentially make ₹10 million, ₹1 crore, and therefore you can afford to, because the opportunity is so much more, you can afford to pay a lot more to the better quality engineers. So you will see, and we are already hearing of significant wage inflation starting to show up in the companies hiring SaaS engineers, right? Because so the best quality talent they will also be encouraged to do startups. So I think there can be some cost pressures that can emerge for the listed IT services firms. At the same time, there's an opportunity, right? So if a bunch of sort of independent young engineers can create software as a service and sell it to large corporate clients, then companies that already have very established relationships, I think it's a great opportunity for them. And these companies that are large and listed have also sort of evolved, right? So they, from doing Y2K to doing .com work to doing now cloud, I think they have also been changing. So they are led by some excellent managers. So, and the valuation you get on this type of revenue can actually be much higher than what you get on typical services revenue, right? Because services revenue is considered low quality, but this one can actually, the startups get valued at 10 times revenues. So there is an opportunity, but I think the cost pressure side is something that perhaps may show up much before the companies can actually transition. But we'll have to see that, right? So it's not a very easy answer that, if IT is enabling it, then IT services firms are going to do well. But I think in terms of other enablers, look at the fintech stack. Look at the fact that, when we started with the Jam Trinity, which is Jandan Aadhaar Mobile, that was 6-7 years back, we built applications on top of it. So we have, the best, I would say, public digital architecture. You have things like UPI, which are now developing, which have now, really ramped up and are proving how transformational this thing can be. On top of that, as my colleague recently wrote in his fintech report, Ashish, that the business models which have been created on top of that, so a lot of data is available. Regulation-wise, the account aggregator model, where you can get, a customer can authorize the sharing of the data of their bank account transactions, cash flow transactions, tax payment transactions, etc. And then there are lenders who can use that data and lend, right? So cash flow based lending. So this was something which 4 or 5 years seemed like a pipe dream or something which was very long term. Now it is imminent, right? And the business models which started off by the 20,000, 50,000 rupee tickets are also now mature enough. Those algorithms have been trained better and are now more trustworthy. So now you can get into higher ticket size. So this is actually imminent. And I think, so in every sector, there are sector-specific enablers, right? So like say e-commerce. Now e-commerce by itself is a great opportunity, but e-commerce and new age distribution is also a public good, right? So today, if I have a great idea for a consumer product and a great brand name and advertising, I'm a great, say suppose I'm not, but suppose I was a great brand enabler, a brand creator, I don't need to worry about distribution. I don't need to worry about being forced to advertise at a national level, right? Because earlier, 20 years back, you could only give ads on Doordarshan. And then you needed to have national distribution to be able to amortize that advertising cost. Now I can do focused brand building. I don't need to worry about distribution. I can just focus on product creation and brand creation. And we are seeing some fascinating new companies coming up across, processed food, cosmetics, and a lot of other things. So e-commerce, so these are, I think, multiplier effects. And I think for the medium-term outlook of the economy, once we sort out, all the excess financial tightness that we had created in the last 3-4 years, and that is starting to get solved, it makes me very constructive on the medium-term outlook for the economy.